Hi, today we're speaking with Keith Baer of IBM and Amir Khawaja of Calypso, and we're going to have a bit of a conversation about centralized clearing of over-the-counter derivatives. You know, this is kind of a hot topic right at the moment, and it's being mentioned by a lot of regulators as a way to reduce risk in the financial system. But, you know, we're seeing a lot of traders kind of moving to centralized clearing prior to the mandate. You know, the CME offers a service. But the ultimate question really is, you know, Keith, I'll start with you. Will this make the system any safer?
I think that's a good question. Obviously, the intention of the regulations with Dodd-Frank, et cetera, have that in mind, and also to increase transparency. But obviously, to a certain extent, the swaps market had an involvement as far as the financial crisis was concerned, the role of credit default swaps, for example, in the housing market, et cetera. So it is understandable why centralized clearing is seen to be a solution to those kinds of problems. But clearly there are many issues associated with how that could be implemented in practice in order to reduce risk. For example, there's obviously a significant concentration associated with moving from bilateral trades onto a centralized clearing environment. That has an impact in terms of the overall risk within the system, if you like. It puts an awful lot of onus on the CCPs themselves to be able to understand and analyze risk, which is obviously particularly difficult if it's illiquid instruments, very limited historical information in terms of pricing, for example. So how risk is actually calculated, especially as more and more complex instruments migrate onto CCPs, is going to be a significant challenge. That in its own right has implications for the CCPs in terms of what kind of technologies and risk engines they need to implement, what kind of connectivity, what kind of market data needs to be sourced in order to be able to reduce the risk effectively.
Yeah, that brings me on to the next question. There will be a lot of new instruments added into the system. You know, will CCPs be able to handle this deluge of new instruments?
For the earlier set of instruments, obviously, as you mentioned, CME are already, I think, have at least 15 clearing members, 500 clients using their services. So obviously the train has left the station as far as that's concerned. However, I think most people agree between 60 and 70% of the volume is likely to, from the OTC markets, is likely to move to centralized clearing. And by the time the more complex instruments and the less liquid instruments are migrating over, obviously there's going to be, you know, increased challenges in some of the topics I was referring to before. So it gets progressively more difficult as the migrations actually move forward, I think.
Amir, I noticed you were agreeing, nodding to that.
It will make the market safer because we'll go from a world of many market participants trading with each other to a net portfolio managed by a CCP with better risk management. You know, with the margins being collected daily, automated in a way. You know, less dispute. So I think it'll be a far more efficient marketplace. Also, I think it's your second question about which products. I think more instrument types are better because the more we can clear, the more people have in terms of portfolio benefit to net. But clearly, only instruments where there's a established market price at a standard can be cleared. Instruments that are, you know, illiquid or there's no accepted market price need to be registered in a trade repository, but not cleared otherwise. Losses will be shared by the members, right, which is not really the aim of clearing.
Yeah, so what are some of the other requirements being set out by various regulations? You know, I mean, how will it affect, you know, real-time and public reporting and rules around block trades?
The objectives are to reduce risk, as Amir says, and also to increase transparency. And increased transparency implies you know, trades should be reported very quickly, and the regulations talk about as soon as that is technologically possible. But as you say, block trades are obviously the issue. And there's a difference of opinion, I guess, between both the CFTC and also the SEC in terms of what constitutes a block trade, what kind of levers are available to reduce the risk in terms of real-time trade reporting, be it delays as far as block trades are concerned, to allow positions to be hedged following execution. Also in terms of limiting some of the disclosure around aspects of the trade itself. And also other aspects as well in terms of being able to manage the risk associated with block trade. So clearly that's a very important piece because for some markets such as credit default swaps, there is a very large trade size and therefore a higher percentage of trades that would fit into that block trade category than in some of the other asset classes.
So what are some of the main challenges banks are facing in order to clear directly? I mean, how is it going to affect their internal processing systems and real-time risk management, for example?
If you process, say, interest swaps currently, then your risk on your back office is going to change immensely. And so it's quite a different process. So, from process of confirmations, counterparty settlement with individual counterparts, you have to move to a process of fiscal and clearinghouse. So that means that they have to understand which of their current software and systems they're going to use in this new world of change, right? And is the start point the interest rate swap systems, or is the start point your exchange trade future systems? And I think both have merits. But I think what's really important is that as these products clear, they will remain individual trades or OTC trades. They won't become futures. So that means your operations have to handle them in that fashion. Right? It just means that they're all netted together, and you make one margin settlement to the clearinghouse and to your clients in each currency on each day. But in essence, they're still individual trades that have a life cycle. And I think so that merging of the OTC workflow and the exchange traded way of margining, I think, is what people need to think about. And that really in our view, requires investing in both on the people side and on their software to make sure it's efficient, because it's going to become more automated, which typically leads to higher volume, more SDP, better exception management. So I think that's a world we're entering for OTC derivatives.
So I wanted to give you guys a bit of a surprise final question. There's been a lot at the press, especially in the US, about when regulators will force banks to trade centrally. I mean, April 2012 has been mentioned. So when do you think this will come down, this mandate will come down?
I mean, clearly, as you said, it is reported that April is the date, and that's causing obviously quite an amount of consternation because it's earlier than I think most participants were expecting. I think there's arguments in terms of the phasing, in terms of how those rules actually come in over what kind of period of time through next year. But there's always a challenge, I think, of trying to make it happen as soon as possible in terms of getting the benefits of reducing the risk, etc. But at the same time, there's a reluctance, I think, to, in some respects, revisit the rules, revisit the kind of changes that are being made simply because of the cost of those changes in the first place. So a high incentive to get it right first time. Therefore, balancing those two situations and the conflict associated with that, I think, is one of the challenges facing both the regulators and the participants in the market.
Yes, so I would say, I mean, the G20 commitment is end of 2012. That's the G20 commitment, and I think while the US is much further ahead than, say, Europe and the Far East, I think there's clearly a desire for it to happen at the same time. To have a level playing field for all global banks, right, and local banks. So I would say it's more likely to be the end of 2012, particularly as we see that most market participants are not there, right? So maybe the large tier one firms have the ability to do that, but then their clients might not be ready, so they can't do client clearing. And many local banks have simply not invested what they need to be ready in Q1, Q2 next year.